Hello everyone, welcome to chapter 3 of the Axis Circle. In this chapter, we will be going over the exact procedural frameworks for the layers that we discussed in the previous chapter. So let's first of all talk about the main objective of this chapter. Now you already know what it is because I just told you, but let me reiterate the objective again just so that I could make sure that we are clear on what I'm going to talk about. Okay? Now the whole point and the whole purpose of this chapter is so that I could provide you or hand you over the exact procedural frameworks that I personally use every single day on a consistent basis. Okay, I'll be giving you the exact guidelines and protocols for each one of the layers that we discussed. And this isn't going to be just some random, vague, step-by-step setup or protocols. Instead, this will be the actual stuff that I actually follow every single day. Okay? Now, being aware of the layers and the theory behind them is all sweet and sunshine and butterflies, but what matters is how you actually use and apply them in live market conditions. And that is why in this chapter, every layer that we went through in the previous chapter, whether it's directional bias, market context, or the execution layer, all of them will be now broken down into actual real and usable guidelines. Okay, and I'm going to make sure that I operationalize those layers into something that you can actually use every morning to perform your analysis before you trade, and something that you can reflect on after every single trading session so that you could properly journal it. First of all, let's dive into the first layer, which is the directional bias layer. Now this layer has two active components. The first one is the structural component, which where we build a directional idea. Okay, it is used to build a directional idea. And then we have the narrative component where we refine that directional idea into a clean and objective directional bias. Okay, now let's move on to the next slide and let me give you the step-by-step procedural framework for determining structure and building a directional idea. So here is the exact step-by-step procedural framework for structure. The first step is that we begin with developing or establishing a macro directional context. Okay, now before we even touch structure or touch price action or approach price action, we first want to build a macro directional context using two concepts: the quarterly framework and seasonal tendencies. Okay, so with the quarterly framework, what we are going to do is we're going to map out the past quarterly trends or the past quarterly shifts and see whether where we had a major quarterly shift happen historically, and then ask ourselves whether based on that are we likely going to continue this trend that we are in, or are we setting up for a quarterly shift or a quarterly reversal. Okay, what we are doing here is observing past quarterly shifts and asking whether the trend is going to continue or are we about to have a shift or a reversal. Okay, in this step, we will use quarterly framework and seasonal tendencies to build a higher time frame directional expectation based on time-based behavioral patterns. Okay, this isn't going to be based on price action, but rather based on time-based behavioral patterns. Okay, now I'll be showing you exactly how to do that in the next slide, but this is what we're going to do in the first step. Okay, and once we've done that, then we move on to the second concept within this step, which is the seasonal tendencies. And this basically just means asking yourself and looking at the seasonal charts and seeing and asking how does this asset usually behaves in this particular month or in this particular time period. And then through these two elements together, you could build a macro directional context or your first directional hypothesis. But it's just a hypothesis for now. It's not an idea, it's not a bias, it's just a hypothesis. And then after that, we will move on to step 2. And then within this step, we will use market structure and liquidity metrics to test the macro directional hypothesis. Okay, macro directional hypothesis. It's written idea here, but this should have been hypothesis. I should have removed this word, but let's just ignore this. So what I was saying is that we will test the macro directional hypothesis against real price action to either validate it or invalidate it. Okay, and if it's validated with the help of structure and liquidity metrics, then that hypothesis will be used to add clarity to our analysis, or you could say that will be used to add conviction to your idea. And if it's invalidated, then that hypothesis would be dumped. Instead, we will give priority to this component because structure matters more than the macro directional context. Now, if you are wondering that what is the point of establishing a directional context when the second step, the structure matters more than that, then the idea there is that if you have a directional context that is aligned with structure, then in that case you could have more conviction in your analysis. But if it's the opposite and the directional context isn't aligned with structure, then in that case you would give priority to structure, but you would be much more cautious about the directional idea and you would be much more informed about the existing risk that we have. Okay, and the way we do that is by, first of all, we start with the basics of market structure. We apply the core principles of market structure by measuring key highs and lows and looking at price action and seeing whether price is breaking above highs and rejecting below lows, or it's breaking below lows or rejecting above highs, which helps us determine the current market structure. And then on top of that, we overlay that structure with liquidity metrics to either support or challenge that directional idea. Okay, and this adds context to the structure and helps us identify both short-term and long-term draws with the help of IRL and ERL. And by the end of this step, by the time you're done with this step, you will then have a clear and a directional and an objective directional idea for the market. And then we move on to step 3, in which we refine that directional idea with market profiles. Okay, now that we've got a directional agreement between the macro directional context and structure, we will then use market profiles to refine that directional idea or refine price action into specific phases, profiles, and cycles. This is what we will do in this step. And the key benefits of this step are that it protects us from trading inside manipulation profile before the expansion profile has begun or before the expansion profile starts, and it helps us from entering too early during ranging profiles when price is still consolidating, and it helps us avoiding chasing price action too late after the expansion profile has already played out and liquidity has been swept. And all of this tells us if the directional idea is actually tradable or if it's better to wait. So when you go through all of these three, the macro context, the structure validation, and market profile alignment, by the end of it, you will have a directional idea that's not just based on guesswork, but it's actually built on real-time logic and aligned with how price behaves across time, structure, and behavior. Now let's move on to the next slide and let's see how we can transform and turn this directional idea into an actual directional bias. Okay, now this part right here is basically what ties everything together. It turns your analysis from being just a bunch of highs and lows and structure into an actual logical story, and that story then tells you where price currently is, where it's likely to go, and how it might get there. And the way we build that logical story is through these three steps. Number one, we define the active dealing range. So the very first thing that we do is we identify the most recent and the most relevant expansion swing, and we define that expansion swing into a dealing range. Okay, and then we ask ourselves, and we look at price action and see where is price sitting within that dealing range. Is it in premium or discount? Has it moved out of a previous dealing range and entered a new one? And this is important because it gives us a positional context regarding price action. Then the second step is we identify appropriate key levels within that dealing range. Okay, once we've defined and identified a proper dealing range, a relevant dealing range, we then move on to the second step, which is that we identify appropriate key levels within that dealing range. And we also identify which key level price could use to react, or which key level price could use as a catalyst for an expansion move towards the drawn liquidity. And that means we're not just marking every order block and every fair value gap within the dealing range. Instead, we are looking for a specific key level with a proper logic behind it. Okay, we are looking for a key level that makes the most sense for price to react off of and have that expansion swing or that range expansion towards the drawn liquidity. And this is basically where your bias, your structure, and your liquidity logic all comes together. And then after that, we move on to the third step, which is that we connect the origin to destination. What that means is that by now you know the directional idea, you know the direction of the market or the underlying trend that the market is moving in. You also know the likely origin of that move by identifying the dealing range and then identifying the appropriate key level within that dealing range. Okay, you know the exact key level that price is going to use as a catalyst for that expansion swing that it could potentially have. And along with that, you also know the destination or the drawn liquidity for price, which could either be in the form of the external range liquidity below or above the dealing range, or it could be other key levels within that dealing range. So what you do is you put them together, and basically that's your narrative, that's your directional bias, and that's the storyline that you're going to be trading for the day or for the week. And by the end of this process, by the end of this step, you should have answers to three critical questions. What direction are we trading in? Meaning what direction to trade? From where is that move most likely to begin? And where is it most likely to end? So we just talked about and discussed the first directional bias layer, and I also gave you the procedural frameworks for that layer that I personally use to dissect or break down price action. Okay, so we talked about the directional bias layer. Directional bias layer. This layer has two active components: building your directional idea through structure, and then turning that idea into a directional bias through building a narrative. Okay. Then we discussed the exact procedure framework for structure. Within it, we had 3 steps. And those 3 steps were, first of all, establishing or building a macro directional hypothesis, then validating or invalidating or assessing that hypothesis with structure or the ideas within structure, and then refining that idea with market profiles. Now let's discuss each one of these steps in a bit of detail, and let me give you a graphical representation of them. Okay, first we will discuss how to build a macro directional hypothesis. So we do that with the help of two concepts. Number one, quarterly framework, and number two, seasonal tendencies. So what we do first of all is we look at the seasonal chart for our respective asset. Okay, and the seasonal chart basically tells us or gives us a 12-month overview of how that asset has behaved historically on average in the past 20 to 30 years. Okay, it may look something like this from January to December. This is basically how a seasonal chart looks like. Then based on this seasonal chart, we look at it and let's say we are trading in the month of October. Let's say we are trading in the month of October. This is the October's range. Now we look at how October has behaved, how this asset has behaved during October historically on average in the past 20 to 30 years. And you can see right here is that during the month of October, this asset typically has formed bullish price action on average in the past 20 to 30 years. And this basically gives us this directional hypothesis that October usually tends to be what? It tends to be bullish. So now we have formed our first directional hypothesis based on seasonal tendencies. And then after that, we look at price action and see how price has behaved or what sort of price action did it form in the last 3 to 4 months. And then we use the underlying ideas within the quarterly framework, within this concept, and build another directional hypothesis based on that behavior, based on the behavior of the last quarter. Now, the underlying idea within this concept is that every 3 to 4 months, we have a quarterly shift. So let's say if price has moved in a bullish direction in the past 3 to 4 months, then it's highly likely that we have a quarterly shift the next month. Okay, or if we have had a quarterly shift in the last month, then this month is highly likely expected to continue in that direction. Okay, now obviously this isn't true all of the time, but this could be used to build a directional hypothesis. So let's say based on the price action of the last 3 to 4 months, we expect price action to have a bullish quarterly shift. So that also gives us this another directional hypothesis that we can have bullish price action. And combining all of these two together, we have another bullish hypothesis. Now let's say if one of them suggested bullish price action and the other one suggested bearish price action, then in that case we would just completely dump this idea because both of them are not in alignment with each other. But if they are aligned with each other like we have in this instance, then we will have a bullish hypothesis. Okay, this is basically the first step. So let's say in the first step we built or established that we have a bullish macro directional context based on the behavior of the last 3 to 4 months and based on the seasonal tendency chart. So now our objective, our second step is to validate or invalidate this directional context. And what that means is that we will use the concepts of market structure and liquidity metrics to essentially determine whether we are moving in a bullish trend or a bearish trend. And we do that by looking at the key highs and lows and seeing whether price is rejecting below lows and breaking above highs, or is it doing the opposite and rejecting above highs and breaking below lows. Let's say price is moving in a bullish structure, then in that case the structure component validates the macro directional hypothesis, and in that case you would have a clear directional idea, which is that price is moving in a bullish directional trend or the underlying directional idea is bullish. So now we have both the directional hypothesis and structure both in alignment with each other, and they are saying that the underlying directional idea is bullish. The next step is that now we will refine this directional idea with the help of market profiles. And let's say we are looking at this price action, and right here we can see that we've already had our expansion profile. So in this case, we would expect price to have a retracement profile, and once that retracement profile is completed, only then we can have an expansion higher and we can continue this underlying trend, and price can continue moving higher in this bullish direction. And by the end of these three steps, you would have determined that the underlying direction that the market is moving in is bullish, or the directional idea here is bullish. Okay, so your directional idea here would be bullish for price action. And you establish this directional idea by using these three steps. Okay, but obviously, as you know, this directional idea alone isn't enough. Now we have to refine this directional idea and turn this and transform this into our directional bias. And we do that using two steps. First of all, defining the most recent and the most relevant dealing range. Then identifying appropriate key levels within that dealing range that price can use as a catalyst for the expansion swing that we are expecting price to have. So in this example, our first objective is to define the most active and the most recent and relevant dealing range, which in this case would be here. See, let's say price did this. So in this case, this would be our dealing range. The next step is to identify the key levels within this dealing range. Let's say the key levels are here. The most appropriate key level is here within the discount region of this dealing range. So now based on this logic, even when the underlying directional idea is bullish, first of all, we would expect price to have bearish price action until we rebalance this dealing range and reach the appropriate discount key level within the dealing range. Until that point, our directional bias would be bearish. And once price rebalances the dealing range and reaches that origin and reaches that discount key level, only then from that point on, our directional bias would turn to bullish. And we will start expecting bullish price action. So now that we've gone through the directional bias layer and its procedural frameworks, both for the structure and the narrative component, let's now move on to the next piece of the access framework, which is the context layer. Now this layer is a lot more straightforward. Within this layer, we just have one active component, which is outlining. And all that really means is that we are defining the current and the most recent market context through a dealing range and key levels on the intermediate time frame, which is obviously the 4-hour time frame. Okay, now some of you might be wondering that Sham, that's exactly what narrative helps us with, and how is it different in that? Then the answer is that you are somewhat right, because both in the narrative part and this layer right here, we use the same procedural framework, but the only difference and discrepancy between both is the fact that narrative is used for building a directional bias on the higher time frame, or a directional narrative on the higher time frame, like the weekly and the daily time frame. But this contextual layer only deals with the intermediate time frame, where we will actually find key levels and dealing range and a dealing range for our trades, and we will use key levels within that dealing range to actually frame trades around or take trades off of. Okay, that's the only difference between the two. But remember, it's an important difference. because the key levels we determine in the narrative component of the directional bias layer are only used for anticipation purposes for price action regarding where it wants to go and from where. But the key levels that we will determine in this contextual layer on the intermediate time frame would actually be used for framing trades on the lower time frame. Okay, that's the difference. Now let's talk about how to actually build a proper market context in real time using this procedural framework. The first step is define an active or the most recent or the most relevant dealing range. Now, the important thing here is that this dealing range can't be just a random one. Okay, it can't be in either of the direction. Instead, it must be aligned with the higher time frame directional bias. And what I mean by that is that let's say you are trading on Tuesday, and on the higher time frame, on the daily time frame, you determine that the directional bias for Tuesday for you is bearish. So now your job on the intermediate time frame, on the 4-hour time frame, would be to define and find and identify a dealing range that is aligned with that directional bias, meaning it must be a bearish dealing range. It can't be a bullish dealing range because your directional bias is bearish. Similarly, if your directional bias is bullish, then you would have to find a bullish dealing range. Okay, so it can't be just a random one. It must be aligned with the higher time frame directional bias. Okay, and this is the first thing that we do. In this step, we will identify the current dealing range and determine where prices inside the dealing range, and this basically gives us the positional context of price. Okay, just like it did in the narrative framework, except here we are specifically doing it on the 4-hour time frame, and that's the core difference. The second step is to identify an appropriate key level along with a CRT or a candle range within the dealing range. Okay, that's the second step. So once you know whether you are in premium or discount, you will then look for refined key levels within that range. You will look for multiple key levels within the premium and discount region. And then you will identify which key level and which candle range or CRT price could use to react or use as a catalyst for an expansion towards the drawn liquidity. In the second step, you will identify an appropriate key level along with a CRT within the dealing range, and then you will use them together to frame trades around or frame executions around on the lower time frame. Now we could have two scenarios here. The key level or the CRT within the dealing range could either already be formed beforehand, and in that case you could just identify it and use it to frame trades, or you're going to wait for it to form first and then identify it. But regardless of what scenario it is, that's what you're going to do on the 4-hour time frame. And then the third step is to wait patiently for price to approach the key level or the candle range. Okay, by now you've probably already defined or outlined a proper market context in the form of a dealing range, a key level, and a CRT. Now the only thing that is left is for you to wait for price to approach it without making any dumb or idiotic decisions in between. And this is exactly where most people fuck up. They can easily identify or outline a proper market context on the 4-hour, but what they struggle with is patience. Okay, what they do is they jump in because price is moving, or they think price is just going to expand higher without them, and they feel FOMO there, and that's what leads them to making dumb decisions in between and taking invalid trades that don't make sense, and that leads to unnecessary losses. But instead, what you will do is you will wait for a price to approach the key levels or the candle ranges that you would have marked out or that you would have outlined, or the market context that you would have outlined. And until that happens, you will do absolutely nothing. You'll just wait for price patiently until it approaches your levels. Now, let me give you an example regarding how to build a market context, a proper market context on the 4-hour time frame in alignment with the directional bias on the higher time frame. Okay, this example that I'll be giving you is an actual trade that I executed myself last week on Monday. Now, if you watch the breakdown, then you would know that my directional bias on Monday last week was bullish. Okay, my expectation for price was to first of all rebalance this dealing range, that this micro dealing range that we had formed, and my expectation was for price to have a range expansion higher on Monday to rebalance this dealing range and reach this premium key level. Okay, now I'll move on to the 4-hour time frame and I'll show you how I built a proper market context on the 4-hour time frame and how I framed a trade towards the short-term drawn liquidity, which is higher. Okay, so first of all, Monday opened right here. Okay, so first of all, the first thing I needed to do was to define an active dealing range in the direction of the higher time frame directional bias. So the higher time frame directional bias is bullish, the drawn liquidity is higher, so I look for a bullish dealing range. And the most recent expansion swing that we have is this move right here. So I'll take this expansion swing as my dealing range. Okay, so now I've defined the dealing range. The next step is to identify an appropriate key level within this dealing range. So the only discount key level we have within this dealing range is this order block right here. Now, if you're wondering how is this candle an order block, then this is what we call a propulsion block because it has tested this previous order block. Okay, this is what we call a propulsion block. A propulsion block is an order block that is formed by testing a previous order block. Okay, so this is a discount order block that we have within this dealing range, and this is also aligned with the direction of the higher time frame directional bias. Okay, this is a bullish order block. So obviously I don't trade during these times because this is not a key time. These are not key times. I'll first of all wait for the London Open kill zone, and then during that time I'll wait for price to approach this key level. Okay, so I'll move forward now, and right here you can see that during the 9 p.m. candle during Asian range we formed this candle. Now obviously just as I said, I don't trade during this time because this isn't a proper time or a key time for me to trade. I only trade during the London Open and the New York Open. Okay, so when this formed on Monday, I took this candle as my candle range, and the reason for that was it closed just above this order block. So I took this as my candle range. This was also aligned with the higher time frame directional bias, and then during London Open, my expectation for price was to first of all purge this candle range low, approach this key level, and this as a whole was my market context on Monday. And my expectation for price was to obviously do that, reach and approach these levels, and then from that point on I wanted to frame trade here on the lower time frame towards the drawn liquidity higher. Okay, so this is how I managed to identify or build a proper market context on the 4-hour on Monday. And then during London Open, what happened is price first of all purged below the candle range low, tested the discount key level, rebalanced the dealing range, and at this point I framed a trade here on the lower time frame, and then you can see price expanded higher towards the higher time frame directional bias. Okay, this is exactly how you build a proper market context. So after establishing a directional bias on the higher time frame and then building a proper market context on the intermediate time frame within the second layer, we then move on to the third layer, which is the execution layer. Now again, I still haven't yet uploaded the execution framework chapter yet, so I'm not gonna go through this at this chapter because you'll have to wait for that chapter to drop, and then within that chapter I'll give you the procedural frameworks and explain all of this to you. Okay.